I'm going to start off with a little humor and a line from my favorite comedian, the late, great Mitch Hedberg, who said, "I find a duck's impression of me is greatly swayed by whether or not I have bread." And I think we all know what he means. And in this case, I thought, is the Fed the bread and is the market the duck? Because if the money is there, you're going to go to it.
Hey, Brian, good to be with you. Well, perfect analogy here. I mean, that's the game we've been on the last 3 years, right? One intervention after another. 2018, it was tax cuts. 2019, it was repo and balance sheet expansion, 3 rate cuts. And this year, we have unlimited QE and, of course, rates at 0. And the market continues to run from stimulus headline to headline. I mean, we saw it again this week. You know, you get stimulus optimism, it goes up, stimulus pessimism, it goes down. The market is conditioned and entirely dependent on ever more liquidity to support the valuations that we have right now. We just came out of a 10% correction on the S&P, 15% down on the NASDAQ. So we just had a rally here, obviously supported by oversold conditions going into early October. But let's keep in mind, even if we get stimulus, you know, we're still looking at the historic highest valuations in history, which is kind of ironic because at the same time, we have Fed governor after Fed governor come out and warn of dire consequences if there is no stimulus. That's how fragile the construct in this recovery really is underneath. So I think participants are really dependent here on believing that, you know, ever more stimulus will continue to support ever higher valuations. And I think that's the big
Sven,
question.
It has. I mean,
Absolutely.
It has. Now, to your point, as you've pointed out, it affects the dollar. And if the dollar goes down, the market tends to go down. You have pointed that out. The dollar looks like it might be turning around higher. How important is the U.S. dollar to the equity market?
You know, Brian, it's fascinating. In late August, I spotted a bullish pattern on the dollar that came on the heels of markets continuing to make new highs into the September high. And that bullish pattern broke out here in early September, and we saw equities react inverse. Equities dropped. So it was a really clear relationship. And the bottom in equities came exactly at the point when the dollar actually hit the March low. So there was a technical pivot there. It reacted, and now we see the bounce. So what's happening with the dollar is, I think, incredibly important to continue to watch. My technical view on this right now is there is potential for the dollar to use this weakness to build what is called a bullish cup and handle pattern. If that is so, and it's not confirmed at this point, we may see a surprise push higher in the dollar, which could pressure equities again. So I think depending on what's happening here on the stimulus front is tremendously important on how it impacts the dollar and thereby by extension equities.
So, you know, even with the means behind it, which is obviously the Fed and the stimulus event, at some point that may run out. Who knows? Although money printing maybe necessarily does not have to run out. Do you see any end to the market rally, however distasteful or based on the Fed it may be?
Look, I think that the seasonal script that we typically see is that there's going to be a year-end rally. Let's suppose if all the potential negatives are being removed, like election uncertainty or what have you. I think the big question marks here are obviously what's happening with the virus in reality. We see, again, virus spikes in Europe. We see continued announcements of permanent layoffs. The jobs picture is not as pretty as we'd like to see. The jobs recovery has stalled in a major way. And, if the market really is that dependent on stimulus and that stimulus gets delayed into sometime next year, for example, into February or March or beyond, we don't know yet what the political construct is. We may find ourselves in a situation where the recovery is slowed tremendously. And again, we're looking at massive high valuations and volatility. Despite the fact that we're close to all-time highs here, volatility index continues to be very elevated. It's not priced out any risk. So from my perspective, we still have potential for a massive VIX spike into the election, for example.
Shepard Smith here. Thanks for watching CNBC on YouTube.